future. We're talking real money.
Hello again, everyone. Welcome to another exciting hour and edition and podcast of Talking Real Money. I am Don McDonald here in Florida. Tom is over there in Seattle and in Washington State in the Pacific Northwest. And what we do is we hang out with you and we talk about money. We try to make it make more sense for you. Easier to deal with, less confusing. Oh, I got to share a story with you, though, really quickly. Top of the hour break.
Surprise there.
Top of the hour break, I ran downstairs to say hi to my wife.
Yeah.
And the minute I got to the bottom of the stairs, I hear this music from the television area. And I heard the music, and instantly I said, "You're watching a Hallmark movie, aren't you?"
Oh. So she's not sitting there listening to the show?
No, she never listens to the show, which is why I can get away with some of the stuff I do. So
me too, by the way.
We'd be in such trouble.
No more boyfriend jokes. So yeah, I got it. Okay.
You have been making boyfriend jokes for as long as I've known
it's not
you.
Funny. It's not funny.
So anyway,
don't make them anymore. Okay.
855-935-TALK is our phone number. If you've got a question, we'd love to talk with you. In this hour, we're going to talk about real estate, one of your favorite topics, because everybody's got an opinion about real estate, and there aren't a lot of, the facts are lacking. And what got me talking about this or thinking about this was a piece in Money Magazine that listed the 10 states with the highest gains in home equity, not the prices of homes, but the gains in the money you have in your home, the extra money, the available cash.
The price minus the cost of selling, minus the taxes, minus what you owe somebody else, that part.
And this is just 1 year gain. This is a 1 year gain.
Okay. Yep.
In 1 year.
I was surprised by the list, frankly.
Hawaiian homes had an average gain in equity of $64,000 in 1 year.
I can see why. Actually. It's kind of sunny.
Florida is number 10 on the list at $28,000.
California up 51,000. Number 2, Massachusetts at number 3 up 45,000. I was surprised, frankly, by Massachusetts, Rhode Island, and I got to be honest with you, I was shocked that Washington State is not on here.
It's not on there. Well, because lately it's softened. Lately in the area, it has. Okay. I mean, it hasn't been as high flying as it once was. But what was really interesting was their list of states with the highest amount of negative equity. Now, let's explain what negative equity is.
Well, that's where when you do all the things I just mentioned, you end up with less than zero, right? I mean, it's you owe more on it than
you're upside down in the house. Now, that's hard to believe. But in 1 year, people lost, just
equity. They haven't lost it, but
The equity's gone down in Wisconsin by 2.6%, even though Wisconsin is one of the states with the biggest rise in home equity, too, which I find fascinating.
Yeah, Louisiana was the worst at 6.1% decline. Iowa, I mean, the Midwest, home prices don't move around the way they do on the coast, but down 4.9, Oklahoma 4.1, North Dakota 3.7. You get the point there.
The Midwest, the flyover areas have tended to fare the worst. So when you say that real estate overall makes money.
Well, and that's a good point, because I consider, since the time I bought my house literally at the previous peak.
Yes,
the summer
you did.
Of 2007. Literally,
2007, right at the top.
Get Tom in, and then it was up, and then it went straight down for about 2.5 or 3 years, pretty significantly too. My neighbor had to get out of his and lost money, had negative equity. But since then, frankly, it's been basically up, and we had a few periods of tremendous growth. But because I read this, I did the number. Mm-hmm. The price of my home, were I to sell it for what Zillow says it's worth today, which may or may not be able to do, is about twice what I paid for it. It's about a double in those 16 years. Okay?
Yep.
Right?
Yep.
That is only, I was like, well, how much is that annually? That's only 4.6% a year.
That's right.
Sound like that. I mean, it feels, oh man, look at all this, but that's not that great a return when you look at everything else.
Well, let me give you another number. This just to compare it. I did the same thing since you mentioned that. I took my house, which I purchased 25 years ago, and I'm right at a triple in the value. And that is get this, I bought at a better time than you, and that's just a flat 4% per year. Just 4% per year. So while these things are nice to live in, are they great investments overall?
Tom and Don are talking real money.
In medicine, a second opinion might save your life. With investing, a second opinion might save your future. The trick is getting one without a high-pressure sales pitch. Well, I'm Don McDonald, and if you've been listening to Talking Real Money, you know that our goal is to help everyone create a brighter future by investing and managing money better. That's why, in addition to helping everyone on our show and podcast, we are also committed to making our 100% fiduciary advisors at Appella available to help everyone make the best financial decisions based on science. So if you're being pitched a financial product or a system, make sure you get a second opinion with no cost, no obligation, and no annoying sales pitch by going to TalkingRealMoney.com or call 800-386-3004. That's 800-386-3004 or TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
While we love sharing things with you, and we do love sharing stories and anecdotes and financial information and great ideas that we run into and bad ideas that we want you to avoid like the plague, our favorite thing to do is to talk with you. 'Tis the season to talk money, so give us a call at 855-935-8255.
That's pretty good.
Wait, that was way too many.
Keep your day job.
Yeah, no, I'm not saying
close.
855-935-TALK. That's it. That's the number. Okay? It's not really a number. It was a word at the end. Sorry, misspoke. Nate, you're up next. Welcome to Talking Real Money. Nate?
We know you're there.
I hear you. Well, I hear his phone line.
Is he asleep?
I don't know that I actually hear him.
No, you're right. We hear
Nate, did you step away from the phone?
Nate. Yeah. Nate is late.
Oh, look at him being poetic. All right, so we're just going to say, bye, Nate. Sorry. Give us a call again.
He's going to skate.
Oh, okay. It's just going down. Stop while you're ahead.
Very late. I'm sorry.
All right.
Okay. I'm sorry.
I don't want. There's no need to debate. Just move on.
Watch out for the plate.
So let's talk a little bit more about home equity.
Yeah.
While we're on the subject,
it's a fascinating topic because I think people we've discussed this many times. They inflate the return of real estate generally.
There's a lot of salespeople involved.
Yeah, I get it. And I'm going to go pick up my grandsons later today. My daughter might not let them go if she's listening because she might say, "You hooked on real estate today," and that's why okay. All right, you're making a living. I get that, but you got to be realistic. And as I said, to me, it does feel like I made a lot of money in 16 years to have a double, but really you haven't. Well, part two is you still have to sell the thing, right? I mean, just see what the price is on Zillow. That doesn't mean anything. You got to get that money, right? So,
well, not only do you have to sell it, but then you got to find another place to live.
That's a continuing issue. But here you are, perhaps the issue that seems to arise generally for us is people come in and say, well, I have this $1.5 million home, which frankly in Seattle is, fine, but it's not outrageous. I owe $500,000 on it. And so I have all this money. Can't I live on that in retirement? So the question is how to access that.
Right. How do you access that? You asked the question, answer it.
Okay. Well, a HELOC would be one.
Well, but
I didn't say it's perfect. I said it's a possibility. That's one way to do it, right?
Okay, all right.
You could.
All right.
Home equity line of credit. Not ideal today when you're probably looking at 10% or something, I guess.
That's what I'm checking.
You could refinance the note you have on it, which is lousy timing. Again, I get it because I think you're still looking at 6.5%, 7% to borrow money on a mortgage today too. And then there's our least favorite, but for some people the only way they can finance retirement, and that is a reverse mortgage. which
but there are issues with that.
Oh, and there's none of these are perfect. I'm just saying these are ways you could get at that money, which for many people is substantial. It truly is. We understand all that. I had difficulty saving for whatever reason. I paid down my house a little bit. Now I got all this money there, et cetera. So a HELOC, refinance, or reverse are ways that you could access home equity in retirement. Ways to get at it.
Yeah. Now I did look up HELOC rates. The average HELOC rate right now, and these are they're always adjustable. For all intents and purposes, these are going to be adjustable rate second mortgages. And so we're talking about 10+% for the average.
Yeah. And up until very recently, that would be outrageously expensive money. But, today companies are borrowing it at over 10.
Still isn't. The fact of the matter is that accessing that money is going to be costly. It's going to be complicated. That's one of the reasons why today, in this environment right now, renting is a more sensible financial decision than buying. It's cheaper to rent than it is to own.
They hate that. People hate that, though.
I know they hate that. But
I want to own part of the action. I want to be in there. I want to be part of all this.
But the difference, the Wall Street Journal just did a paper on this. $2,000, a $2,000 rent is going to cost you $3,000 in home ownership.
But if you go out to ask people, out of the 2,000 people, you're going to get 1,900 going to say I'd rather own than rent.
Even though it's 50% more expensive.
They're just going to say, I'd rather be an owner, man. I don't want to be a renter.
Then what that tells you is it is an emotional decision,
I think
not a financial one.
I think it is.
If you want to make the smartest financial decision for your future, even let's say retirement, it's better to sell that house right now.
Indeed. And this is a great time to do it.
Exactly. This is we haven't seen as good a time ever.
No, absolutely. This would be the time to sell. The other thing about renting is just think in my situation, if I was just renting my house, no above ground pool for sure, right?
You mean the WTP?
They wouldn't let me have. I'm teasing. Yeah, they wouldn't let me have that. So, but you're right. The fourth part of getting the equity out of your home in retirement would be selling.
Yeah, but now let's think about your home for a moment.
Yes.
If you sold your house today,
paved area for your silver bullet.
If you sold your house today. You have a ton of equity. You could walk in to a nice community, get a nice 3-bedroom apartment, and probably get it for $3,500 a month.
That sounds low, but you could be right. I don't know.
No, if you stay out in the woods like you already live in the woods.
See. They built apartments out there?
Sometimes, speculators, real estate investment trusts.
From Canada sneaking over during the night or something?
But the reality is having equity in your home, and that's really what we're talking about, is a mixed blessing. Because it is hard to get to.
Yeah.
It's not when we say my net worth and you add in the $700,000 you have in equity in your house.
Yep.
Well, is that really part of your net worth if you don't plan to sell the house?
I don't think it is. I think you have to set that aside.
Yeah.
The other part is this is another reason not to, and I know it's a bad habit of all of ours, wasn't for me until about a year ago, to pay down the mortgage faster.
Yeah.
Because what you're doing is you're limiting
No.
as I just pointed out, the return has been less than a mix of stocks and bonds over the long haul.
If you're like us, and you got one of those 2.5%, 3.5%, 4%, 4.5%, 5% mortgages.
Yeah.
Why would you pay that down?
I know. It's emotional. You just feel good. Throw another 1,000 at it. Boom.
Yeah, because this is not like the 1930s when you had mortgage burning parties, so that
even you and I can't remember the 1930s. Okay.
No, but or the 40s or even maybe the 50s. But back in the 30s, it was the evil banker with the mustache that he twirled.
The Monopoly game. Yeah, right.
Yeah.
Okay,
So anyway, give us a call, 855-935-TALK. We'll talk about anything that's money-oriented, your real estate, your investment portfolio, your retirement, your kids, your future college plans for those, your future retirement plans, and a whole lot more. 855-935-TALK. It's really easy. I'm Don. That's Tom. Don't go away.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Wow, it's interesting. The average HELOC rate just 2 years ago, just 2
7%.
years ago, 4.
6? 4. Crazy.
4.
Yeah.
855-935-TALK. That is our phone number. Give us a call. And Nate is back. We've got Nate back. Nate, welcome to the show.
Here. Yeah? Oh, he's there.
Hey, it's great to be back, guys.
Hey, it's good to have you back,
Welcome.
Nate. We've missed you.
We missed you. Yeah, we really did. What's up?
Oh, I'm sure I missed you guys, too. Hey, love the show. You guys give great information, and especially appreciate the banter. It's terrific. I've got 2 questions for you.
Yeah.
First of all, I wanted to register for Retire Meet 2024, but I live in Virginia, so I'd have to attend virtually. And when I went to the website, I didn't see anything about connecting in virtually, so I was wondering how that would work.
Well,
Nate,
that's
Nate, here's the deal.
Yeah.
Yes, it will be available. Right now, the powers that be have decided it makes more sense to just promote the local event and get people to show up. But later, it'll be open for everybody online. So.
and it'll be free.
Keep that down.
Oh, I'm not supposed to tell
Okay.
people.
Don't say
Well, that's-
no. It won't be free to go to it in Bellevue, but it'll be free to attend virtually. So stand by.
Okay, my lips are sealed. All right, now for my second question. You often speak about finding a 100% fiduciary advisor, and I believe that's absolutely crucial. But I guess my question is, when I think of 100% fiduciary, that's somebody who's working in the best interest of the client. And that, I would think, should go just beyond the financial to also include their psychological well-being, their emotional well-being. And I was wondering if somebody was experiencing anxiety about their future situation, their finances, despite being given education, being given information, if perhaps it's just their nature, if talking with them about a single payment immediate annuity might be something that still could be considered under the 100% fiduciary umbrella.
Of course. Absolutely.
We agree.
Because that's the key. You see, I've held for a very long time that the financial knowledge is not the most important factor in a financial advisor-client relationship. That a financial advisor is really a financial psychologist more than anything else. There's so much talking off the ledge that needs to happen.
You need to know your client. You need to build a plan that works for your client. And then here's the tough part. You need to keep them on that path, because many times when things get good, like they've been the last 6 weeks, people say, "Oh, I want to buy that." Nope, that's not part of the plan. Or when things get ugly, "Oh, I got to get rid of that." Nope, that's not how it works. So you're absolutely right.
And then when it comes to someone, there are people, and we've said this is the exception to our hatred of annuity rule. The exception is someone who needs and cannot stand any outcome other than absolute certainty as to the check coming in every single month, or as close to absolute as we can get, of course, considering you're dealing with a private insurance company that could fail, and the backstops could fail too, but it's relatively safe. There are immediate annuities that are non-commissioned that advisors can find someone to help a client put together.
You still need to remember, when you buy that immediate annuity, if there's no commission, that's even better. But remember, they're still giving you your money back for the first 16 or 17 years. You don't get theirs for a long time. If you're okay with that, you just want to live with it, as Don said, guarantee, take it.
But that's a rare situation, Nate. That would be a rare situation. That would be after an advisor has already gone through every single method they have at their disposal to show the client that going without it is financially likely better for the client. Likely. But there are a lot of unknowns, and there are certain people there. I think they're rare who have to have that absolute certainty, but they exist.
Nothing in life is 100%.
Yeah. Or frankly, they feel like it's certain.
Having been through a lot, I haven't found it yet, but I hope somebody does. Normal life. Yeah. I wish them well. Good luck finding it. Thank you for your call, Nate.
Thank you, Nate. We appreciate you. 855-935-TALK. That's our phone number. It's really easy, and we really, really, really love talking with you. So give us a call this holiday season, or if you're listening to this after the holidays, this non-holiday season.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Look, Tom, Santa brought what I asked for Christmas.
That is funny, I gotta say.
Oh, you mean the picture I sent you?
Yeah, the picture.
Oh, yeah. There's a thing on Facebook. My sister posted it, and it's a silhouette of a camel. But if you look at it the right way, if
somebody suggests something,
if somebody suggests it, it looks like a grandmother who fell forward while gardening into the grass.
A little unkind in that regard, but it is quite funny.
It is funny. Anyway, no, what I was going to say is we got our Christmas wish. We asked for callers, and Santa brought them. 855-935-TALK is our phone number, and Bo, you are on the show.
Can we say it?
What?
Bo knows the show? Oh, sorry.
No, that was bad. Okay. Hi, Bo.
Hey, can you guys hear me?
Yeah, we can. Can you hear Tom? I hope not.
Thanks. Thanks for taking my call. I mean, I listen to you guys, and I will never call that show, man. That's a bunch of old people. But then I turned 61 and a half now.
Oh, jeez.
Wait,
dude, you're almost as old as we are. Don't you give me that old people thing.
Dial a phone and everything. Well done, sir. Okay, good.
I'm not speaking it. You take this call, Tom.
I was kind of interested in...
Yeah. You go, Bo. Go ahead.
I'm sorry for hurting that one feeling that you got. All right? I'm sorry.
That's all I have left at this age.
All right.
Oh, I'm going in my booth now.
Yeah. Lock the outside.
All right. First of all, in listening to you guys while I'm on hold, you mentioned HELOC, and I gotta say, I think the HELOC's really something. I mean, you mentioned your house that's gone up, mine too. My house is worth $615 to $675, and I owe $220. So I went to the HELOC people. Shoot, you guys, they gave me $220,000, no questions asked. All I do is pay the interest payment on it. So then I figured out how to loan that money. You know, there's hard money and soft money. Loan that money to a construction buddy of mine. He does the work. We end up paying it off. A way to make money on your house and not pay taxes on it. Now, I'm sorry. Did I say that? Taxes?
Yeah. That last part, that's illegal.
We know your number, Bo. We're giving it out here soon. So
But Bo.
The HELOC's good. I like the
HELOC. What if his real estate business goes bad?
He's 4 years older than me, and he's lost $1 million 3 times. So I have faith in him. Yeah, no, he's really good at what he does. Yeah. So
wait a minute.
Mama.
Don't go there, Tom. Don't go. Let it go. Let it go. Just let it rest.
Now let me say the next part.
Yes. Yeah.
All right. So I got a 401k. So that was house money. So I got a 401k, and on the little website, and I don't want to mention any competitors or whatever.
You can mention competitors. We don't care. We live in America.
All right. America. Voya.com is my people. And
we're familiar.
There's a calculator on there. Mm-hmm. How old you are, what percentage you put in, what you estimate you're going to make on that. Boom, boom. And at 62, I'm kind of skinny. At 65, I'm fat. I mean, PHAT, fat. All right? So I'm going to stay till 65. Now I went to my stock guy or my 401k guy. and he doesn't manage my stuff. And he goes, "Oh, you're very aggressively invested." Well, this year I've made 22% on my 401k. It's gone up $90,000. So, and then he goes, I go, should I back off? He goes, the damage has been done. You'd just be giving away money to back off now. And I honestly believe that every 3 years it's a cycle. All right. So I'm not too late or too early to start thinking about that between 62 and 65. I want to hear what you say.
Well, okay, first of all, to make 22% this year, the Standard & Poor's 500, the index of the largest companies in America, is up 25%. So 22 is not outrageous. A globally diversified portfolio is up about 15%. So what you've done is not outrageous. I have no idea what this person at Voya is talking about when they say you've already inflicted the damage.
No, that's the 401k guy. That's the 401k guy. You're getting your character.
It's run by Voya. It's run by Voya.
Oh, is it? Oh, okay. Yeah. It's run by Voya.
Well, it's run by them, but he manages our company's 401k.
Yeah.
Plan.
Well, the fact of the matter is your company is doing you a disservice by using someone who's as expensive as Voya is. The other thing is 22% you can't count on. What you can count on is a lot lower than that. 855-935-TALK.
Tom and Don are talking real money.
Do me a favor. Grab your latest investment statements if you know where they are. How many do you have? A lot? How many different investments are in each statement? A bunch? Do you own individual stocks, bonds, sector funds, and stuff you don't understand? Yeah, I thought so. I'm Don McDonald, and I'm pretty sure you have a case of hodgepodgeitis. But don't worry, it's not terminal and can be cured. But it takes three things: a bit of time, some fiduciary guidance, and a plan. There's a problem, though. Most financial advisors can't or won't provide any of those. That's where we come in. Tom and I will provide you the help you need to overcome hodgepodgeitis in a free, no-obligation meeting with an Appella advisor at TalkingRealMoney.com. So, scan or take a picture of all those pages you gathered, then go to TalkingRealMoney.com, click on Meet an Advisor, and set up a free appointment online or by phone when it's convenient for you. Let us sort through the mess and help you get started on a better, simpler future plan. Just go to TalkingRealMoney.com or call 800-386-3004.
Your guides to a really great financial future. Tom and Don are talking real money.
Can I finish up with Bo first before we move on to Dave's not here? Is that okay? Because
whatever.
Okay, here's
do
the
what
thing about
you need
Bo,
to do.
which I love. I love his spirit, by the way, I do. First of all, I never, ever, ever recommend you borrow money to then invest that money. This
No.
Late
Excuse
90s,
me.
people were doing this too. They're doing HELOCs and
See,
putting in the market,
you
et cetera, et cetera.
You did the absolutism statement again.
Yeah,
never. Okay.
Have
we said in the past? Excuse me. Have we said in the past? If you have a 2% mortgage, don't pay it off. Keep it in your investment portfolio. Same thing.
Is that the same thing?
Yep.
To go out and borrow money?
Because you're borrowing money when you could have paid off your house. So you're,
okay.
Yeah.
Okay. All right,
don't say never ever, but to pay 10% to invest it.
Right, and then make twice that because of the loans. Number two, in terms of his 401k, if he's all in stocks, which it sounds like he may well be, and he's going to access this money in 3 years, he should have a few bonds in there. I'll just say that.
I think that's a good thing to say. Yeah. That makes absolute sense. 100%, absolutely, all the time. That makes sense.
I'm glad for that.
The other one, I don't know. 855-935-TALK, 855-935-8255. And as Tom alluded, Dave is here. Dave, welcome to Talking Real Money.
Dave?
Hello?
Hey, Dave.
Yes.
What's up?
Can you hear me?
You're on.
Yep.
Yeah, okay. So I was just wanted to ask, you guys talk about that it's not good, it's better to rent than buy, and you sort of equate them straight across, but there's a couple of problems. One is when you buy, you're not putting all the money down, you're leveraged, so the value of your home goes up is leveraged. And then two, if you're renting, we have no equity, so it's all just floated down the river, where when you're buying, you're paying interest to the bank, but at least you're getting some equity out of it. So it seems like the calculation is a little more complicated than just straight across, well, $2,000 versus $3,000 a month. right?
It really isn't, actually, though, because the money you're not putting down and the money you're not paying toward the mortgage, you should be investing in something that may have a better rate of return than what both of us calculated on our homes. Our rate of return, that was dollar on dollar. That was the true rate of return on the money we put in, was right around 4% per year. And boy, it's a long period. For Tom, it was 16. For me, it's 25 years.
But you live somewhere. You would have to live somewhere, so you have to pay rent. So then you would have paid all that much in rent. So you're saying the difference of $1,000 a month between renting and buying, and then the equity you got out of that versus the money you just would have lost by renting.
But what I'm saying is if I'm paying $2,000 a month in rent, let's just use these numbers because that's what the Wall Street Journal used. I'm renting for $2,000 a month versus buying for $3,000 a month. The money that I wouldn't have put down, first, we'll start with that, my 20% down or whatever, that can be in an investment portfolio that could be making 8-10% per year conceivably. Plus the $1,000 a month, instead of putting it into the house, I should be putting that into my 401k or my IRA that, again, could conceivably make double-digit amounts, whereas home prices over 100 years. We got more data on home prices than we do on anything. The average annual return on homes has actually been pretty pathetic.
Interesting. All right.
Yeah, by the way, these are not our numbers.
Yeah,
these are
we didn't make these up.
We didn't come up with it, and we have no hatred of home ownership because we're both homeowners. I've been a homeowner for, that's like 45 years, a long time. So something like that. Anyway, but for the reason, and thank you for your call, Dave. The reason that Don and I own homes today, I think, is we like living there. I like living where I live.
It totally is a lifestyle decision.
It is. So, and so that we're just trying to make that point. And this is a weird shift in a way now due to interest rates that makes it even unprofitable. That's what the Journal was trying to get at. Now, in this environment, just doesn't make sense from a financial standpoint. I get it psychologically. There's a lot of other reasons people want to own homes, part of a community. Totally get that. That's not what our argument is.
Yeah, that's the reason I'm never getting my wife out of this house is the community. Really, it's the community.
No, she loves it. She loves her friends there. Built a nice life. So, kind of Mickey Mouse.
Yeah, we're not saying houses stink. We're just saying we talk about two different things, and we do this regularly. There's the emotional, and there's the fiscal, and the two rarely meet up comfortably. There's a lot of discomfort associated with the right fiscal decisions. For example, the right fiscal decision for an investor is to has been in the past to invest in equities. That would have been the right financial decision, but a diversified portfolio to avoid the big mistakes. But that's an uncomfortable thing to do.
Because you, at some point, could find yourself at 50% less than what you had not long before. That's the issue, right? And I would put it, again, we talked about this last week, but in dollars.
Yeah, please do it in dollars, yeah.
If you have a 401k when you're 33 years old, it's $300,000, and then a few months later, it's $150,000. You okay with that?
Ouch.
Most people are not. That's all. So,
and we know that from literally asking in person thousands of people.
Well, no,
raise your hands.
Asking,
how many of you are comfortable losing half of your $1 million?
We've rarely got a hand there. But I've talked to people on the phone, clients, when they're down 20% and want to quit. Or when the situation it's different this time because it's the pandemic, or it's different this time because it's the election, or it's different this time because it's a war. I'm like, no, all those things have happened. But people, I got to do something. I got to get out of these stocks. That's the issue we're talking about.
Yeah, the reality is there will always be a reason to do or not to do something. Mm-hmm. And you can make all kinds of excuses. But you have to this is where the discipline of all of this comes into play. You have to do the things that are best for you, despite your judgment, your what's the best word for it? Your instincts.
Yeah, that's the word.
Your instincts going against it.
All the way back to thousands of years ago. We know it's all wired into our brain. Jason Zweig wrote that beautiful book, Your Money in Your Brain. You want to understand the decisions you make? Read that book.
Yeah, that is a truly, maybe one of the best investing books ever written.
It is, because then you go, yeah, I remember. Yeah, I see why I think this. So it's an important thing to know about yourself. I will say that.
Yeah,
because
it's kind of
people do.
It's kind of sad that after all these years, we finally learned that all we are is just a cellular computer. We're a cellular computer with a computer code inside of us, which is our DNA telling us how we're going to do what. Man.
And I had to learn this week that I'm closer to the Neanderthals than I thought. That
you are,
hurt.
yeah.
Actually,
Well, and when I looked at that picture that the Wall Street Journal had of a
see the
Neanderthal,
slope there? It looked
I went,
pretty close.
Except for the formerly blonde hair, it kind of looked a little
now
like.
You're really gonna hurt.
Anyway, the story is now you have to tell what the story is. That people.
This is also from the Journal. Yeah.
People who get up early risers tend to have more Neanderthal genes in them than do late risers, because us late risers, we were the Neanderthals had to get up early to go out in the woods and catch some things before the smart people came out and killed the Neanderthals. 855-935-TALK.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Hello again. Welcome back to our little program. I'm Don. That's Tom. And he still has his mic on the FaceTime.
No, I turned it off.
No, it's
my
on.
Neanderthal. No, it's off now. I turned it off.
I just heard you, but then, okay, never mind. It's a little Neanderthal brain. We have a question that actually came in off the air. Somebody did not want to go on the air and ask this question, so I'm going to ask it of you. I think that you can nail this one, because I want to give you something to make you feel a little more confident in yourself.
Sloped forehead or not.
Yeah,
okay,
sloped forehead or not.
Yeah, okay.
What is the difference between points and percentages?
I don't know.
No, think about it. Oh, okay, like points. Like 100 points. What's 100 points? Basis points. They're talking about basis points.
Oh,
basis points.
I don't know how to describe a basis point unless it's in like a percentage.
Well,
I wouldn't know how to describe that.
That's what I'm saying. Okay,
just go
I
ahead
thought
and
this
say
was going
it.
to be easy for you.
I know. Well,
a basis point
I should be out chasing deer or something.
A basis point is 1/100th of a percent.
All right.
100 basis points is one.
That's right. Okay.
Yeah. 200 basis points
I didn't know what
is
you're asking for.
2%.
Yeah.
Okay. So a basis points are just another way of expressing percentages. Basically, there is no difference. They're the same. It's just a different way of expressing it.
Because it's confusing.
I agree. It's what we do in this stupid industry.
I know.
We create confusing things, which is why we try to avoid it. But every once in a while, we fall into the jargon trap, like everybody else. When you're in a business for a while, you'll say the jargon because you think everybody knows it. And one of the things you need to call us on once in a while is if we get too jargony, say, no. Back to the English language. We need to talk. You need to talk to us like we don't know anything about money, which most people don't. But if you want to learn more about money, boy, do we have the opportunity of the year.
And it's coming up.
Only once a year.
And we get Don out of his booth, out of Florida, to come to Bellevue for retirement. This is the 10th year.
I know.
Came up with.
And 10 years ago, 11 years ago, Tom, 9 and 10, almost 11. Tom told me this was not going to work.
Well, I will publicly admit that I was wrong. I was wrong.
That's more proof.
Yeah, that's good. One day, we talk all things retirement, financial, housing, healthcare, estate, all in person in Bellevue. Some of the top people, including Paul, Herb Weisbaum, Don, Paul Merriman, pardon me. They're all there. And right now, if you sign up really early, like right now, because the event's not till the 24th of February, then you get a Talking Real Money mug of which you can drink coffee out at the event.
And a discount.
Yeah, you get the early bird discount. So get those tickets now. Retire Meet. That's 2 E's.
No. It's also.
I don't know if that's worked.
It works. I checked.
Oh, it does.
Yes.
Retire Meet.
So
as
even
in where you go to buy your
if you
steaks.
think that it's all about getting meat in when you get older, I want to retire with meat. MEAT. Type that in. It also works. So you can retire with meat, or you can meet the future of your dreams at the Retire Meet 10. 10.
Unbelievable.
We can't
Join
be. We are that old. Darn it.
I know.
So anyway, go to retiremeet.com if you want to learn more about us and the show and the podcasts and all that cool stuff. And if you want to meet with one of our advisors, just go to talkingrealmoney.com, talkingrealmoney.com.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.